What if the biggest corporate Bitcoin bet in history is starting to crack? A few months ago, investors were told something that immediately sent shockwaves through the crypto market. According to Strategy's leadership, Bitcoin would need to collapse toward roughly $8,000 before the company reached a true debt danger zone. On the surface, that sounds reassuring. $8,000 is nowhere near current prices. But that headline hides a much more uncomfortable reality. Because the company that helped invent the corporate Bitcoin Treasury model is now underwater on one of the largest Bitcoin positions ever assembled. And they are not alone. Across the market, companies copied the playbook. Buy Bitcoin. Raise capital. Watch the stock price explode. Repeat. It worked beautifully during the boom. Now the market is asking a very different question. What happens when the trade stops working? Welcome to Web3 Verse. Let's start with the giant in the room. Strategy, formerly MicroStrategy, has accumulated a Bitcoin position so large that it represents a meaningful slice of the total future supply. The company spent tens of billions building that position, with an average purchase price sitting above current market levels. That means one thing. On paper, they are underwater. Now, unrealized losses alone are not the issue. Plenty of investors survive temporary drawdowns. The real debate revolves around the famous $8,000 figure. Many people misunderstood it. This is not a classic margin call level. Nobody automatically liquidates Strategy if Bitcoin falls below their average entry. Their debt structure is more complicated. Much of it consists of convertible notes rather than traditional collateralized crypto loans. That distinction matters. Unlike leveraged traders on an exchange, Strategy is not forced to instantly dump coins during normal volatility. Their Bitcoin stack is not sitting under an exchange liquidation engine waiting to get wiped out. So why are analysts still worried? Because the danger isn't hiding in a liquidation price. It's hiding in the calendar. Debt maturities, interest obligations, investor expectations. Eventually, obligations come due. And if Bitcoin enters a prolonged bear market while those obligations approach, the math changes fast. Some note holders may want repayment. Equity issuance becomes harder if the stock price weakens. Raising fresh capital becomes expensive. And suddenly, a company built around holding Bitcoin might need something it doesn't naturally generate enough of. Cash. That's the pressure point. Now, to be fair, Strategy is not defenseless. They maintain reserves. They have planned for difficult environments. Executives have repeatedly discussed long-term approaches to managing or restructuring debt exposure. But here's the part the market is watching closely. Strategy built a fortress. The copycats did not. Over the last cycle, an entire ecosystem of corporate treasury imitators emerged. Public companies rushed into digital assets. Some leaned into Bitcoin. Others chased Ethereum treasury strategies. For a while, almost anyone could announce a crypto treasury plan and watch investor enthusiasm pour in. The model looked unstoppable. Until prices moved against them. Because once your treasury asset drops below your cost basis, the story changes. Balance sheets weaken. Equity value shrinks. Fundraising power disappears. And companies without diversified revenue streams suddenly discover how dangerous concentrated crypto exposure can become. That is where things get interesting. Some treasury firms entered aggressively near elevated price levels. Now several are staring at massive unrealized losses. And unlike established businesses with strong cash generation, some of these firms are essentially pure crypto exposure wrapped inside a public company. That structure becomes fragile during prolonged downside conditions. And the market is noticing. Major investors have already begun reducing exposure to certain digital asset treasury plays. When experienced capital starts exiting an entire trade category, traders pay attention. Because smart money rarely moves without a reason. Meanwhile, analysts have warned that multiple treasury companies could face elevated risk if market weakness continues. And that brings us to the nightmare scenario. Not one company failing. Contagion. Think about the feedback loop. These treasury firms have been major buyers of crypto assets. Their purchases helped create demand. Now imagine that demand suddenly disappears. No fresh buying. No easy capital raises. No aggressive accumulation. That alone changes market dynamics. But the supply side is where things become truly dangerous. If weaker treasury firms run out of runway, they may become forced sellers. Not because they want to sell. Because they need to. And forced selling creates reflexive pressure. Prices fall. Balance sheets deteriorate. More firms face stress. More assets get sold. Prices fall again. Crypto investors have seen this movie before. Luna. Three Arrows Capital. Cascade events do not wait for perfect technical setups. Forced sellers ignore support zones. They sell to survive. Now, does that mean Bitcoin is heading to $8,000? Probably not. In fact, many analysts consider that scenario extremely unrealistic. For one major reason: production economics. Mining costs matter. If Bitcoin collapsed dramatically below large portions of the industry's production cost, the pressure on miners would become extraordinary. Network incentives would face severe stress. Historically, Bitcoin has endured brutal drawdowns, but catastrophic price levels require extraordinary conditions. There's also another factor many critics underestimate: institutional participation. The Bitcoin market today is not the Bitcoin market of a decade ago. Large asset managers hold enormous positions. Institutional vehicles control billions in exposure. Long-term allocators, sovereign capital, pension interest, this is a very different landscape. These participants are not all trading short-term momentum. Many are allocating with multi-year horizons. And that changes the probability distribution around extreme downside scenarios. So what is actually happening here? One interpretation is simple. The Treasury model itself may not be broken. The easy version of the Treasury model is: during the frenzy, buying crypto became a shortcut to market excitement. Some firms used discipline. Others used optimism and leverage. Now the market is separating the two. Well-capitalized players with runway may survive. Underprepared companies may not. And ironically, that cleanup process could strengthen the ecosystem over time. Weak hands exit. Stronger holders absorb supply. The speculation fades. The structure matures. But none of that removes the short-term risk. Because if multiple treasury firms stumble simultaneously, market volatility could spike hard. And that is why investors are watching this story so closely. Not because Bitcoin is guaranteed to implode, but because corporate treasury stress has become one of the most important macro narratives in crypto right now. So here's the real question. Is the Bitcoin treasury model a revolutionary financial strategy still in its early innings? Or are we watching the first major stress fracture in a trade that expanded too quickly? Drop your thoughts below. And if you want deeper breakdowns on the forces shaping crypto markets before they hit the headlines, subscribe to Web3 Verse. Because in this market, understanding the narrative is sometimes just as important as understanding the chart.